What you are witnessing right now is not a market correction. It is not a dip. It is not volatility. What you are watching in real time is the single most significant fracture in the global financial architecture since 1971. And I need you to understand exactly what is happening, because this moment, this precise moment in history, is what every serious monetary analyst has been warning about for decades, and most people are going to miss it entirely because they are watching the wrong story. They are watching the price, and I need you to watch the structure, because the structure is collapsing, and when the structure goes, the price becomes irrelevant because the system itself ceases to function the way you have been told it functions. Let me be absolutely direct with you. Comex, the commodity exchange in New York, the world's largest metals futures and options exchange, is facing a physical delivery crisis, the likes of which this market has never seen. And the numbers I am about to walk you through are not opinions. They are not speculation. They come directly from official CME warehouse reports, official depository statistics, and publicly available delivery data. And once you see what those numbers actually say, you will never look at the silver market the same way again. Here is where we are right now. As of February 11, 2026, official Comex registered silver. That means silver that is actually genuinely physically available for delivery against futures contracts, has fallen below 100 million ounces for the first time in recent history. On that single day, there was a negative adjustment of over 3.2 million ounces in the registered category, bringing total registered silver to just 98,138,005 ounces. And in the same 24-hour period, vaults reported withdrawals of more than 4.7 million ounces from the eligible category as well. That is almost 8 million ounces leaving the Comex system in a single day. One day, let that sit with you. Now, let me put that in context, because context is everything here. Back in October 2025, just 4 months ago, Comex registered silver stood at 167.7 million ounces. Today, it is below 100 million ounces. That is a 38% collapse in registered deliverable inventory in just over 3 months. And the rate of drainage has accelerated to 785,000 ounces per day. Every single day, 785,000 more ounces are leaving the system than are coming in. And that trajectory leads to one place and one place only, a delivery failure. But here is the part that turns this from a serious situation into a historic one. While inventory is collapsing, demand for physical delivery is exploding in a way that has absolutely no precedent in the modern history of this market. In January 2026, which is historically a minor delivery month, not a major one, Comex processed delivery demand of between 40 and 49 million ounces of silver. The typical January delivery figure in previous years, 1 to 2 million ounces. That is a 7 to 10 times increase in a month that is not even supposed to be a primary delivery month. Think about what that means. Sophisticated institutional players, the people with access to the real data, the people who understand exactly what is happening inside these warehouses, began front-running March. They started pulling their silver out early, ahead of the March delivery month, because they could see what was coming and they wanted their metal in their possession before the crisis made that impossible. And then February came, and February's delivery rate has been nothing short of extraordinary. As of early February, 18.72 million ounces had been called for delivery out of February open interest of 19.17 million ounces. That is a 98% delivery rate, 98% in a normally functioning futures market, a market that is working as it is supposed to work. The vast majority of contracts roll forward. They never actually result in physical delivery. That is the entire premise of the paper market. The contracts are financial instruments, not physical claims on metal. But when 98% of contract holders say, no, I want my silver, I want the actual bars, I want physical possession, that is not a futures market anymore. That is a physical allocation mechanism under extreme stress, and the exchange is struggling to maintain the fiction that everything is fine. Now I want to talk about March, because March is where this entire situation reaches a critical juncture, and February 27th is the first notice day for the March contract, first in which means we are right at the edge of what many analysts are describing as the most dangerous delivery period in Comex history. Here are the numbers as they stand right now. The March 2026 silver futures open interest represents approximately 429 to 528 million ounces of notional exposure. That is somewhere between 85,000 and 105,000 contracts at 5,000 ounces per contract. The registered silver available for delivery, which was 103 million ounces as of February 5th, has since fallen further and may be as low as 85 million ounces by February 27th if the current drainage rate continues. So you have somewhere between 429 and 528 million ounces of paper claims competing for somewhere between 85 and 100 million ounces of physical metal. That is a ratio of more than 4 to 1. 4 paper ounces for every 1 real ounce, and that is assuming every single registered ounce is genuinely unencumbered, not already pledged, not already allocated, not already spoken for by some other obligation. Because here is something the mainstream financial press is not telling you. A significant portion of what appears on the books as registered silver may already be encumbered. These vaults hold metal that is technically registered but is subject to competing claims. It has already been allocated elsewhere, or it is pledged against some other obligation, or it is warehouse stock that custodians cannot deliver without creating another failure elsewhere. The real pool of genuinely deliverable, fully unencumbered silver is almost certainly smaller than the headline number of 98 million ounces. If March sees even 25% of contracts stand for delivery, and that would be a conservative outcome given what February has already shown us, Comex would need 107 million ounces. That may already exceed what will be available on first notice day. If delivery demand runs at anything close to the January through February intensity of 50 to 70%, we are talking about demand of 200 to 300 million ounces against an available supply of perhaps 85 million ounces. The mathematics of that is not complicated. The mathematics of that is catastrophic. Let me now step back and explain to you why this is happening, because this is not random. This is not a speculative bubble gone wrong. This is the convergence of multiple structural forces that have been building for years, and they are all colliding in this moment. The first force is 5 consecutive years of global silver supply deficits. Since 2021, the global silver market has run at a deficit every single year. Cumulative shortfalls between 2021 and 2025 are estimated at roughly 820 million ounces, nearly equivalent to an entire year of global mine production. Those ounces have been absorbed, consumed, used up by industry and investment demand, and they are gone. They cannot be reprinted. They cannot be created by a central bank. They are gone. The second structural force is industrial demand that is not just growing, it is accelerating in ways that are fundamental and irreversible. By 2025, industrial demand for silver had reached 680 million ounces annually, representing approximately 60% of total demand. Solar photovoltaic manufacturing alone accounts for 200 to 250 million ounces per year. Electric vehicles consume 40 to 60 million ounces. And then there is 5G infrastructure, AI hardware, semiconductors, medical applications, and the emerging demand from nuclear reactor control rods as scores of new reactors come online ahead of 2030. This is not discretionary demand. You cannot put solar panels on a roof without silver. You cannot build an EV without silver. You cannot run an AI data center without silver. This is inelastic demand, and it only moves in one direction. The third structural force is China, and this one is a tectonic shift that most Western investors still do not fully appreciate. China has designated silver as a strategic material and imposed export restrictions, cutting off one of the world's major supply channels. Shanghai vault inventory has fallen to its lowest level since 2016. Shanghai physical prices are trading at a premium of $5 to $10 per ounce above Western benchmarks, which tells you exactly where the real demand is concentrated. The global silver market has effectively split into three islands: Asia centered on Shanghai, North America centered on Comex, and Europe centered on LBMA, and each region is fighting for whatever metal it can control. China's export restrictions are not a trade policy nuance. They are a declaration that silver is no longer a freely flowing global commodity. It is a strategic resource being hoarded by the world's largest industrial power. The fourth structural force is what is happening with institutional money. In January 2026, Sprott Physical Silver Trust announced it had doubled its at-the-market equity program to $2 billion from the $1 billion announced just weeks earlier. At silver prices around $110 per ounce, that $2 billion can acquire approximately 18 million ounces of physical silver, representing roughly 16% of whatever Comex registered inventory remains. Sprott is not doing that because they expect silver to stay where it is. They are doing that because they understand the supply mathematics and they want allocated physical metal in their trust before the delivery crisis makes acquisition impossible or prohibitively expensive. Samsung, yes, the technology company, finalized a mining prepayment deal to restart the La Paria silver mine in Mexico with an exclusive clause securing 100% of that mine's output for 2 years. Samsung did not go to Comex. Samsung did not buy paper silver. Samsung paid cash to restart a mine and locked in the production contractually. When one of the world's largest technology manufacturers is bypassing exchanges entirely and locking up mine supply at the source, that tells you something profound about confidence in the existing paper delivery system. Now, I need to talk to you about what happened in London in October 2025 because it is a direct preview of what Comex is now facing. On October 8, 2025, a single order for 1,000 tons of silver placed through the London market caused an immediate and complete freeze. Silver lease rates, which normally trade below 1%, instantly skyrocketed to 200%. 200%. All traders withdrew from the market simultaneously. The Swiss refiner Metalor, which operates in 17 countries, announced it would not return to the market before January 2026. The London freeze of October 2025 was the proof of concept. It showed the entire world that when physical demand meets paper supply in a market where the two are deeply mismatched, the market does not gently reprice, it locks up, it seizes. The mechanism that is supposed to allow orderly price discovery and physical delivery breaks down entirely, and what London showed in October, Comex is now demonstrating in real time on a larger scale. And there is another critical data point that must be named directly. In early January 2026, during the first week alone, JP Morgan issued 99% of 8.1 million ounces in delivery notices through 1,624 contracts. And what is remarkable about that particular data point is not just the volume, it is that January's open interest actually increased by 1,431 contracts, even as deliveries were being processed at that pace. That means new participants were entering and claiming physical metal, even as existing participants were exiting with theirs. This is not a market working normally. This is a queue forming outside a vault that people are beginning to fear may not have enough metal for everyone in line. Let me also bring you a number that I think encapsulates the entire absurdity of the paper-silver system. Since 2020, Comex registered silver inventory has fallen by approximately 75%, 75% of deliverable inventory has been drained in 5 years. And yet, during that same period, the paper market continued to price silver as if nothing had changed. The paper price and the physical reality became completely decoupled, and that decoupling is now violently reasserting itself. The December 2025 delivery month saw 46.635 million ounces delivered, representing 50% of the estimated free float registered inventory in a single month. Then January 2026 surpassed that. Then February came in at a 98% delivery rate. This is not a trend that reverses itself on its own. This is a system experiencing cascading failure. There is also the matter of the lease rate signal, which experienced one of its most extreme readings in modern market history. On October 9, 2025, silver lease rates spiked to 34.9%, with intraday peaks reaching 39.2%, according to Japan Bullion Market Association data. Lease rates represent the cost of borrowing physical silver, and they are perhaps the most sensitive indicator of physical scarcity in the system. When they spike to 35 to 39%, it means that physical silver is essentially unavailable for borrowing at any normal price. It means the institutions that normally supply leased silver are hoarding it. It means the underlying physical market is in crisis, even if the paper price is being managed to look calm. And even after rates came down from those extremes, they remained elevated at around 5.6%, still 5 to 6 times normal levels, signaling that the structural stress in the physical market did not resolve, it merely shifted. Now, I want to bring you something that is deeply important to understand about what happens in these situations historically, because we do have a precedent and it is worth studying closely. In 1979 and 1980, the Hunt brothers accumulated approximately 200 million ounces of physical silver alongside massive futures positions. Silver prices surged from approximately $11 per ounce to nearly $50 per ounce in just months. The exchange responded by implementing emergency rules. Specifically, they changed the rules on position limits and margin requirements in the middle of the game to force the Hunts to liquidate. Silver prices then collapsed. The lesson that most people take from the Hunt brothers' story is that silver squeezes fail. But that is the wrong lesson. The right lesson is that when physical delivery demand threatens to overwhelm a paper market, the exchange changes the rules. They do not let the market work. They intervene, and they intervene to protect the shorts, to protect the banks, to protect the system, not to protect you. And the question that every silver holder needs to be asking right now is, what rules are they prepared to change in March 2026? Because history tells us they will change them. What we are experiencing now is different from the Hunt situation in one critical way. The demand pressure today is not coming from two brothers trying to corner a market. It is coming from industrial manufacturers who genuinely need the metal to keep production lines running, from sovereign wealth funds and emerging market central banks doing shadow accumulation, from institutional investors demanding physical allocation through trusts like Sprott PSLV, from technology companies like Samsung locking up mine output directly, and from ordinary individual investors around the world who are waking up to what is happening. This is not a corner. This is a demand reckoning against a structural supply deficit that has been building for 5 consecutive years. And let me be absolutely clear about something regarding the price, because the price action has been extraordinary and confusing to many people. Silver surged past $90 per ounce in mid-January 2026, setting a new all-time high. It then broke decisively above $100 in late January. It peaked near $121 per ounce, a price that represents a transformation, not just an increase. And then came one of the most violent single-day collapses in commodity history, with prices plunging 31 to 36% in a single session. What happened? CME responded with margin hikes of 60%, repeated successive margin hikes that forced leverage participants to liquidate en masse, regardless of their view on the underlying physical situation. That is the playbook. When the paper system is under threat, you raise margin requirements to force paper sellers into the market, and you suppress the price. But here is what those margin hikes did not change. They did not change the 5-year supply deficit. They did not change China's export restrictions. They did not add a single ounce to Comex registered inventory. They did not reduce industrial demand by one solar panel or one electric vehicle. They bought time. That is all. They bought time for the system to absorb some of the pressure, and that time is running out as we head toward February 27th, the March 1st notice day. Because here is the mathematical reality that no amount of margin hiking can alter. You have open interest in the March contract representing 429 to 528 million ounces of theoretical delivery obligation. You have registered deliverable inventory that is now below 100 million ounces and falling by 785,000 ounces every single day. Even if only 20% of contract holders demand physical delivery, a conservative historical estimate, Comex cannot fulfill those requests from existing inventory alone. If delivery rates match the January and February intensity of 50 to 70%, you are looking at demand for 200 to 300 million ounces against whatever inventory remains by the time February 27th arrives. There are only a handful of ways this resolves. Either Comex finds massive new sources of physical silver between now and the end of February, which is extraordinarily unlikely given that global supply has been in deficit for 5 consecutive years, or Comex converts delivery notices to cash settlements, which is a default by another name and would destroy the credibility of the exchange permanently. Or Comex changes its rules again, expands position limits, restricts who can take delivery, forces cash settlement on a broad basis, or takes some other extraordinary emergency action. Or, and this is the outcome that the paper market has been designed to prevent at all costs, the exchange experiences an actual delivery failure where holders of delivery notices cannot receive their metal, and the entire pricing mechanism for silver, which has been a paper pricing mechanism built on the fiction of physical backing, is exposed for what it is. The 2026 shortfall in global silver supply is projected to approach 200 million ounces. Let me put that number in perspective. Total Comex registered inventory before this crisis began to accelerate was approximately 167 million ounces. The annual supply shortfall alone is larger than what Comex had available at the start of this crisis. The world is consuming silver faster than it can produce it, and it has been doing so for 5 consecutive years, and the deficit is growing, not shrinking. Here is what I need you to take away from everything I have shared with you today. We are at a point in monetary history where the gap between paper claims and physical reality in the silver market has become so extreme, so impossible to sustain, that a structural resolution is inevitable. I have been saying for a long time that there are 2 kinds of assets in this world: real things and paper promises. Physical silver held in your possession is a real thing. A futures contract on Comex, a share of a silver ETF whose metal may or may not be fully allocated, a paper promise of silver backed by inventory that is demonstrably insufficient. These are paper promises, and paper promises fail when the underlying reality cannot support them. We are watching that failure begin in real time. The delivery data is not a theory. The inventory drawdown is not a theory. The 98% delivery rate in February is not a theory. The London market freezing in October is not a theory. The lease rates spiking to 39% are not a theory. These are documented, verifiable facts from official exchange data and market reporting, and they are telling you that the paper silver system is under the most extreme structural stress it has ever experienced. The people who are going to look back on this period and wish they had paid attention are the people who are watching the paper price bounce around and thinking the volatility means nothing. Fundamental has changed. Fundamental has changed. The math has changed. The global supply picture has changed. The geopolitical configuration of silver as a strategic asset has changed. The behavior of sophisticated institutional buyers who are bypassing exchanges entirely and going straight to mines has changed. The delivery rates have changed. The lease rates have changed. The inventory trajectory has changed. Everything that matters has changed, and the paper price is the last thing to catch up to reality. And when it does catch up, the move will not be gradual. It will not be orderly. It will be historic. So what do you do with this information? You make sure you own physical silver, not paper silver, not ETF silver, where you are relying on someone else's counterparty to deliver, not futures contracts. Physical silver that you can hold, that you control, that carries no counterparty risk, that cannot be frozen, that cannot be margin hiked away from you, that cannot be cash settled against your will. Physical silver is your protection against what is happening right now, and the window to acquire it at prices that reflect anything resembling the old reality is closing. In an environment where Comex registered inventory has fallen 38% in 3 months, where the global supply deficit is approaching 200 million ounces annually, where the March delivery math is functionally impossible to reconcile with existing inventory, where China has restricted silver exports, where Samsung is locking up mine production, where Sprott is raising $2 billion to buy physical metal in that environment. Every day you wait is a day closer to the moment when the resolution of this crisis sets a new price baseline that makes today's prices look like history. I want you to be on the right side of history here. The data is clear. The trajectory is clear. The stakes are clear. Make sure your portfolio reflects the reality of what is happening, not the fiction that the paper market is still trying to sell you, because the paper is running out of backing, and when it does, only physical will do.